Momentum oscillators. In this video, you will learn the main momentum oscillators, the relative strength index, the intraday momentum index, the rate of change or momentum indicator, the stochastic oscillator, and the commodity channel index. Momentum refers to the velocity or rate of change of a security's price. Momentum indicators are referred to as oscillators because they oscillate above and below the equilibrium line. All momentum indicators compare price changes from a period to another. These indicators measure whether a rising trend is accelerating or decelerating, or whether prices are declining at a faster or slower pace. The Relative Strength Index, also known as RSI, is a popular momentum oscillator that was developed by J. Wells Wilder and featured in his 1978 book, New Concepts in Technical Trading Systems. RSI compares the average price change of the bullish bars with the average change of the bearish bars of a security. The RSI is calculated using the following formula, with U representing up days and D representing down days. An up day is a day where the close is higher than the previous day's close. A down day is a day where the close is lower than the previous day's close. The default parameters, as suggested by Wilder, is 14 periods, although some traders alter it to change the sensitivity of the oscillator. RSI fluctuates between 0 and 100 with its equilibrium level at 50. As RSI goes above 50, upward momentum increases. When it goes below 50, downward momentum increases. RSI is also used to reveal extreme price conditions. A security is considered overbought when RSI moves above 70, and oversold when RSI moves below 30. Another momentum oscillator is the intraday momentum index, which is also known as IMI. The IMI was developed by Tushar Shande and is considered a crossbreed between the RSI and candlestick analysis. The calculation of the IMI uses the relationship between the opening and closing prices to determine whether the period is bullish or bearish. It separates the bullish and bearish candlesticks and performs an RSI calculation on the candlestick bodies. The IMI calculation focuses on the body size of each candle. It compares a candle's open and close price to differentiate between bullish and bearish days. For example, on this day the open was 1850 and the close was 1900, so we have 50 bullish points. The next day, the open was 1850 and the close was 1750, giving us 100 bearish points. The next day, 100 bearish, and so on. We then count how many bullish and bearish points we have. In our example, for the last 11 days, we have 350 green and 600 red. Now, using the formula, we see that our first point is 37%. The next day, we have a green candle of 150 points. Remember, we always count the last 11 periods. So now we have 450 green and 600 red, which gives us 43% as our second point. When the green points are equal to the red points, the IMI would be at the 50% equilibrium level. This is the intraday momentum index. Similar to the RSI, the IMI default look-back period is 14, but can also be changed to alter the sensitivity of the oscillator. IMI fluctuates between 0 and 100, with its equilibrium level at 50. As it goes above 50, upward momentum increases. As it goes below 50, downward momentum increases. Like RSI, IMI is also used to reveal extreme price conditions. A security is considered overbought when IMI moves above 70, and oversold when IMI drops below 30. The price rate of change, also known as the ROC indicator, is a pure momentum oscillator that measures the percent change in price from one period to the next. The result is the percentage that the security's price has changed in the last X periods. ROC is identical to momentum oscillator, with the only difference of momentum being normalized. The ROC has an equilibrium of 0, whereas the momentum oscillator fluctuates above or below 100. The ROC is calculated by comparing the closing price today to the closing price X periods ago. Let's check how a 4 look-back period ROC is calculated. On this day, the close is at 19. 4 periods ago, the close was 16. 19 minus 16 gives us plus 3, which is our first point on the oscillator. The next day, the close was at 17. 4 periods ago, the close was also 17. So 0 is our next point. The next day, the close is 16. 4 periods ago, it was 18. So the next point is minus 2, and so on. The default setting look-back period for the ROC is 21, representing 1 month. The first interpretation of the ROC is through the centerline crossover. The ROC fluctuates above or below its equilibrium level at 0. As the advance accelerates, ROC expands into positive territory. As decline accelerates, ROC dives deeper into negative territory. ROC is also used to reveal extreme price conditions. Traders can visually identify levels that caused previous turning points. These levels are then used to identify future overbought and oversold areas. The stochastic oscillator is another popular momentum indicator developed in the late 1950s by George C. Lane. It compares the security's closing price relative to its price range over a given time. The stochastic oscillator does not follow price, it does not follow volume, but rather follows the speed or momentum of prices. The formula for calculating the stochastic is as follows: current close minus lowest low of a given period divided by the range of the given period times 100. Let's check how a 5-period stochastic is calculated. In our example, the lowest low of the last 5 candles is at 10, and the highest high at 20, and the current close is 15. Putting these numbers in the formula gives us our first point at 50%. The next day, the close is at 17.5, taking us to 75%. When the close is at 20, then the current close and highest high are the same, giving us 100%. This plot is known as the fast stochastic. Because fast %K is choppy and sharp, it can be replaced with the slow %K, which is a smoothed X-period simple moving average of the fast %K. In order to get signals, we add to the %K the %D line, which is an X-period simple moving average of the slow %K. The default look-back setting for the stochastic oscillator is 5 for fast %K, 3 for %D, 3 for slow %K. Stochastic oscillator fluctuates between 0 and 100. Readings above 80 indicate that the price is near its high for the given period. Readings below 20 indicate that price is near its low for the given period. As a bound oscillator, it is used to reveal extreme price conditions. A security is considered overbought when %K moves above 80 and oversold when %K drops below 20. The Commodity Channel Index, also known as the CCI, is a versatile indicator developed in 1980 by Donald Lambert. It can be used to identify the beginning of a new trend or warn of extreme conditions. The CCI was originally developed to identify cyclical turns in commodities, but the indicator can be successfully applied to other asset classes. CCI measures the current price level relative to an average price over a given period of time. We start by finding the typical price, which is the average of the high, low, and close. To calculate the CCI now, we subtract the 20-period simple moving average of the typical price from each period's typical price and divide the results by the constant times the mean deviation. The constant is by default 0.015, and the mean deviation is calculated as follows. We subtract the 20-period simple moving average of the typical price from each period's typical price. Then take the sum of absolute values of these numbers and divide it by the total number of periods. The default look-back setting for the CCI oscillator is 20 periods. Lambert set the constant at 0.015 to ensure that approximately 70 to 80% of CCI values would fall between -100 and 100. The CCI fluctuates above and below the zero level. Surges above 100 reflect strength and can signal the start of an uptrend. Plunges below -100 reflect weakness and can signal the start of a downtrend. Chartists can look for overbought or oversold conditions around plus or minus 200. However, since CCI is an unbound oscillator, extreme levels may depend on the volatility of the security. In our next video, we will talk about oscillator analysis. Thank you for watching.